Good evening everyone, I hope you are all doing well. In today's video we're going to be running through moving averages in Forex, how you can put these on your charts, how you use them to determine a trade and what they basically mean. So first things first, you're probably wondering what this yellow, blue and turquoise lines are doing on my screen. Well, these are the moving averages, and what a moving average is basically the average of the last 200, 50 and 20 of these candlesticks. So it basically shows you the direction of the market, and they almost act as miniature support and resistance levels within themselves. So these are best used when the market is trending. When I say trending, I mean either in an uptrend like we can see here or in a downtrend. You can't really use the moving averages to your advantage when the market is just moving sideways like we see in this portion here. So that is basically what moving averages are. Now you can add these to your charts on TradingView by clicking the indicator icon at the top. If you type in exponential moving average, if you click that, it will then bring them up here. So click it 3 times to bring up each of these 3, and then to set your moving averages, you then click the settings icon. You'll then change the length to 20, and then 50, and then 200 across all 3 on here, and then you can change the color of those so they all look slightly different, and then they'll look something like this. So the 200 is the most strong of the 3 of the moving averages. The 50 is obviously next in line, and then the 20 is slightly less. So you'll see them sort of stack up in order when the market is in an uptrend or in a downtrend. If the market's in an uptrend, you'll see that they'll be constantly moving up along with the price, and they'll be beneath price like we can see here. If we were in a downtrend, you'll see that these moving averages would be above price, and they'll all be stacked up in the same order but moving down and above. What we can see just by briefly looking at these charts is that these moving averages basically act as a diagonal support. So every time price comes up and then down into these moving averages, price bounces up and pushes higher. The next time it comes back down into these moving averages, particularly the 20 and the 50, it then pushes up and goes a little bit higher. Next time we come back down, we see the same and same and same again, until obviously price starts consolidating like we've seen here. There's nothing you'd really do with the moving averages around here, and then again begins to trend again. Price moves up, pushes down into the moving averages, pushes higher, back into the moving averages, pushes higher, and so on and so forth, until eventually we see another area of consolidation, if that makes sense. So the way you would use the moving averages to take a trade, in this particular example, I'm on gold, I'm on the 1 minute time frame, definitely not advised, but for the sake of this example, we have a nice sort of run of the moving averages and a nice sort of easy layout to sort of explain to you. So where you'd be looking to take your trades from would be the 20 and the 50 moving averages in particular. So all along this region here. So you're looking to trade from here, again there, and again there, and then again up here. So as you can see, just by the first couple of pushes, we've seen the first one into the moving averages, price pushed higher. The second time price came into this moving average, we pushed higher. So anywhere between the 20 and the 50, you could look to place a buy trade to obviously then capitalize on the next move up, and your stop loss will be set just below the lowest moving average out of the 2, which is the 50. So if we took, let's say, this trade for example, we could take the trade anywhere between the 20 and the 50, and we'd have our stop loss set just outside, closer to the 50 than the 200, but somewhere in this kind of region here. Same again with these kind of trades, you could have your stop loss just below the 50, and then you'd enter anywhere within this region. So somewhere between the 20 and the 50 moving average. Again up here, you'd enter somewhere between the 20 and 50, depending on how price was moving, and then again somewhere like this. And final example on this bit of movement here. So as we can see, price pushes up and then pushes down, it pushes back up again, it comes back down into the moving average. We start to see a little bit of buying, we start to see some white candlesticks showing prices rising. We could then enter our trade around here with our stop loss just beneath, and then capitalize on the next move up. As price pushes up higher, we then exit our trade in profit, whether we exit it here, whether we exit it higher, it doesn't really matter, and then you wait patiently for price to move back down into the moving averages again. As you can see in this example, on this bit here, you might not have got a particularly great entry, but then you could have waited for price to push a little bit lower, start to show some signs that was pushing back up again, which we've seen here. We've seen a bit of buying, another bit of buying. You could have entered after this candlestick here and then capitalized on the next move up. Same again with this example. We'd wait for price to come into the moving averages. We'd see how it is reacting, wait to see a little bit of buying. In this case, we saw a little bit of buying on the 1 minute time frame on this candlestick. We could have entered roughly anywhere around here is fine. And again, you're never going to be pinpoint perfect. You might catch it perfectly a couple of times, but there might be a time where you enter up here, price moves down into a bit of a loss for a moment before then eventually pushing higher. And then eventually the trend will change, price will crash through and you'll lose the trade. And then it's just a case of waiting for the market to then begin trending again, which we shortly saw later down the line. Begins trending, pushes into the moving averages, pushes up, pushes into the moving averages, and pushes up. So it did this a couple of times, would have given us a couple of trading opportunities before it then started to stagnate and move sideways, and then absolutely rocketed as gold does. So in theory, that is how you would trade the moving averages. Now this works on any kind of time frame. It doesn't have to be the 1 minute. It works on the 30-minute time frame. It works on the 15-minute time frame. It works on the hourly time frame. It's just a case of waiting for the market to trend. Now obviously you wouldn't necessarily trade using just the moving averages alone. You'd want to sort of couple them with other analysis techniques, your support and resistance zones, your trends, your channels, but this will come in a later video, grouping all the moving averages, all of these zones together for a stronger, more reliable trade. But just remember, when you're looking at the moving averages, especially trading it short term like we've just shown in this example here, be waiting for price to come into the moving averages, and then you'd buy to catch the next move higher. Wait for price to move down into the moving averages, wait to see how they react, then buy to catch the next move higher. And then again here, here, and here until you eventually buy and price crashes through and there's a change in direction. So that's how you trade based off the 20 and the 50. Now you're probably wondering what this yellow 200 moving average is and sort of what it's there if price barely even touches it. We can see that for quite some time price barely even came close to reaching the 200 moving average until we saw a strong rejection around here. Now, like I mentioned earlier, the 200 moving average is the strongest of the three. So when price does eventually make it down into the 200 moving average, it's likely you will see a strong reaction from this level. Now, trading how we've literally just shown here and obviously here when price is trending, the 200 moving average doesn't really come into play, but this comes into play on the higher time frame. So if I go back onto the hourly time frame and zoom out a little, I can show you some good examples of when and how the 200 moving average comes into play. So this is on the hourly time frame now, so we're seeing things from a much sort of zoomed out larger perspective, and many a time dating back to, let's say February 2022. So we can see that every single time price has come down into this 200 moving average, we've seen sharp rejections every single time price has reached this level. So that is sort of what the 200 moving average is there for. It's there to sort of act as a major level of support or resistance. So you'd almost wait to see price come into the 200 moving average, wait to start seeing some rejection from that 200 moving average, then you could enter into your trade and capitalize on the next move higher. Now in this case, we would have had 1, 2, 3, 4 buying opportunities from here. A little bit slow at first as price did creep through them a little bit before pushing back up. But again, similar to the strategy we've just run through, we'd wait to see a price come into this region. We'd then wait to see price start reacting to it and start reversing. Then we could enter into a buy trade and capitalize on the next move higher. Wait for price to come into the region. Wait to see some buying momentum. In this case, it sort of diddled around, not really doing a great deal, and then began to push up. Then you could have entered your trade around here. And then this time it was more pinpoint perfect. And then again here as well. So the 200 moving average is more of a major level of support and resistance. The 20 and 50, as we can see, a good example around here is kind of used just to be trading between the 20 and 50, catching short moves up and down as price bounces from 50 to 20 to higher, back down to the 50 and 20, pushes up higher, back down into the 20 and 50, pushes up higher, and so on and so forth. So you'd have loads and loads of trading opportunities from this. They're obviously a lot smaller moves, so if we zoom in a little bit like this, we can see that the kind of moves you're catching are much smaller, but there's a much higher volume of them. So we could have traded from here, 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 here again, here again. So many different trading opportunities, but again, not very large moves. So you kind of be in and out on those moves, and then trading based off the 200 moving average, which we can see around here. These moves are much larger, but they sort of take a little bit longer to play out. So there's pros and cons of each. But I hope this video makes sense as to how you'd use the moving average on your chart and sort of what the 200 stands for, how you trade the 20 and 50. But like I mentioned, I'm going to be doing another video grouping all of these strategies and analysis techniques together to show you how you'd really spot the highest quality trades and group your levels of support, resistance, channels and trends with the moving averages and a few other things. So I hope you enjoyed this video. I hope you've taken some value from it, and I look forward to seeing you on the next one.